U.S. stock market, large cap stocks are at or near all-time highs. Does that mean we are in a bubble, specifically an AI-infused bubble? Well, I've got some research data points to look at. That and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. The stock market's at or near all-time highs. And what by stock market, I mean large cap U.S. stocks. Small caps are not all the way back. International stocks are not all the way back. So a fully diversified portfolio likely not all the way back. Large cap stocks are, or the stock market, S&P 500. It is, and therefore, does that mean we're in a bubble or we're overvalued? And especially with all of the euphoria and optimism about AI, I have felt that, well, is this sort of similar to the internet and the tech bubble where we thought the internet's going to be able to do all these things and that bid prices up and then, it wasn't able to do all those things immediately and so everything dropped back down. And but now eventually, the internet has met all of those expectations and beyond. Same thing going to happen with AI? Well, let's take a look at history and see a little bit of perspective to see if the fact that we're at an all-time high, and especially where we're at right now, does that mean we're in a bubble and should brace ourselves for a decline? Now, my late father-in-law, he passed a few years ago, back in October of 2007. I'm not making this up. He said, okay, what do you think here? Should we start getting out of the market? You know, the last time the stock market was at this level, everything crashed. And so take a look here at this chart, okay? This shows the run-up of the tech bubble, or a portion of it, from 96 to the peak in March of 2000. And then the 49% decline over the next 2.5 years to kind of around 2002. That was the tech bubble. That was the worst stock market here in the U.S. other than the Great Depression up to that point. And then, like my father-in-law observed, from that bottom around 2002 up until October of 2007, the market came all the way back. And it was back up to where it was in 2000. And then we just could not see. No one saw. It wasn't my father-in-law said, hey, this real estate bubble could collapse here. No, that was on no one's radar, especially in 2007. Maybe Michael Berry's a little bit. So then we saw that decline, and it brought things all the way down, even worse, even below where they were in the bottom of 2002. And that's the lost decade. That's the time period where the stock market, the U.S. stock market, up, down, or up, crash, up, even worse crash. And that lost decade. So does this theology or that thinking, does that apply? That, hey, stock market's back at all-time highs, we should be careful. Well, take a look at these metrics here. Not that they always tell us what's going to happen in the future, nothing does. But back in March of 2000, the forward-looking PE ratio, PE ratio was 25. And that actually was an all-time high at the time, and I'll show you some of that as well. But very, very high, very frothy, if you will. Stocks were expensive. Well, this is what I told my father-in-law. At the peak then, right before the great financial crisis, October of 2007, listen, stocks aren't overvalued, or at least the numbers don't say that. So could things drop? Absolutely. Might you want to take less risk? Maybe. But at least what was present last time that helped cause the drop was stocks were really expensive. They weren't expensive at the peak in 2007 and didn't really matter, actually, the real estate bubble and how the financial system was all connected. That caused an even worse decline, the worst decline since we've seen since the Great Depression. So therefore, again, does it stand, right? Is this something to be aware of? Well, let's zoom out. Let's look at the rest of this chart. If that same logic would have applied, then we got back to those all-time highs, 2013, late 2012. And at that point, you would have said, or if this was the same logic, gosh, we're back to these same levels. We better watch out. And you would have missed a large portion of the 401% rally between the recovery after the Great Financial Crisis and over a decade later. all the way to 2020, right before COVID. And you can see COVID, the fastest decline, fastest bear market ever in history, followed by the best 100 days in the stock market ever. And so we saw that rise, then the decline in 2022, the recovery last year and start of this year. And so if the thought is, well, the stock market does sort of bounce back and forth, sort of like a child bouncing a yo-yo but walking down the sidewalk, it's going to go back and forth in this range. If that's the thought, then this chart looks very different than it actually does. Instead, the stock market is like that child bouncing a yo-yo, but instead of walking along the sidewalk, they're walking uphill. So there are absolutely ups and downs, and there are times when you look and say, gosh, I wish I could have avoided that downturn, but the inevitable recovery, whenever that occurs, even if it's a lot longer than what you wanted it to happen, the stock market has a history of making all-time highs, retreating off of those all-time highs, going on to make new all-time highs. That's how the stock market operates. And you can see now, going back to that chart here, or at least end of February, the stock market level where it is, but that forward PE ratio, 20 times, that's actually more expensive than right before the great financial crisis, not as expensive as a tech bubble. So you'd argue from this, maybe not in a bubble, but I would certainly say US stocks are expensive. Now, take a look at this chart here. This actually shows the number of all-time highs that the S&P has hit in any given year. And so this again goes back to that statement that I stole from someone else, but the stock market has a history of making all-time highs, retreating off of those all-time highs, and then eventually going on to make new all-time highs. We've seen 15 of them so far in the first couple of months of 2024. We didn't see any in 2023. We saw one in 2022. It was right at the beginning of the year, right? But that happens. But look at the record that we saw from 2013 to 2021. All the new all-time highs that were hit. Similar to the recovery that we saw about a similar time after the big inflation of the early 80s, what we saw in the mid 80s and then all throughout the 90s, all those all-time highs. What about in the 60s as well? So making new all-time highs, the evidence suggests in and of itself is not an indicator that, okay, a drop is coming and we need to watch out. All right, so we're now here to the question, is the stock market in a bubble today? Guys, there are a couple things that suggest the stock market is expensive. That doesn't mean you shouldn't invest, and it doesn't mean that a drop is immediately right around the corner. It means the economy needs to grow into where the markets are, and earnings need to follow suit. But a couple of indicators or a couple of metrics are showing stocks are expensive. Take this right here. The tech sector within the S&P 500 at an all-time high price to sales. Now, companies are not valued, so stocks are not valued based on the amount of revenue a company has. Doesn't matter. You can have a ton of revenue, but if you have a ton of expenses, doesn't matter. Your company doesn't have any profit, and therefore it's really shouldn't have a high valuation. Not true at times. When there are a lot of expenses, but there's a lot of hope for a company, you can have a company that has very little earnings or is at a loss. Think NVIDIA for a long time, think Amazon for a long time, think Tesla for a long time, that eventually comes on to be a very valuable company and worth a lot. We are at record high price to those sales, price to revenue for tech companies. That suggests potentially at least a lot of optimism, maybe euphoria, potentially bubble-ish for technology and AI, what we're seeing right now. Next, to me, I do care about price to earnings, specifically forward price to earnings ratio, because that does give us a view of the entire S&P 500. Well, what's the price that I'm paying for a dollar's worth of earnings today? And going back to Benjamin Graham and the unbelievable work that his mind did and the team around him did back 100 years ago, yeah, he'd said Mr. Market sometimes is greedy, sometimes he's fearful. And so for the same company that has the same profits or the same potential profits, some days the market's going to say, oh, for a dollar worth of profit, you got to pay me this. And sometimes Mr. Market's going to say, for a dollar worth of profit, you got to pay me this. And so being aware of that helps successful investors. Now, it doesn't always mean the price to earnings ratio is high, the stock's expensive, therefore we're going to see a drop, but it does help us set expectations. Taking a look at this chart, the average price to earnings ratio over the past 25 years or so, no, that'd be 30 years, the average is around 16. The average is around 16. And then those standard deviations are percentages of the time that it's above and below by one unit, by one metric. And so that street there, that middle dotted line, and then the dotted line above and below, that's sort of the range of what I would say fair value. Stock market's fair valued. And you can see that stocks were cheap in the early 90s or mid 90s. Stocks were expensive during late 90s and 2000s. That's the bubble. Stocks were cheap after 08, the financial crisis. Stocks were expensive after COVID. Where are they now? We're back near or at that expensive level for the U.S. Now, just like we saw during COVID, just like we saw during the tech bubble, it can stay expensive for a while, for a year, for a couple of years. The economy could grow into it, earnings could grow into it, and we might not see a big decline in the markets, but we might see where stocks don't have as much appreciation potential. So this doesn't foreshadow perfectly, but it does tell us, is the stock market expensive? And we've just gotten there after the recent rally this year and the end of last. And then finally, taking that same approach, or for different asset categories or different investments in a diversified portfolio, kind of each of those, what would you be able to look at to say, well, are we fair valued? Is it overpriced, or is it cheap? Taking a look at treasuries and bonds and all of that, you would say, yeah, treasuries, bonds, emerging market stocks, actual international stocks, right now, they're cheap relative to where they've been in the past, historically, 25-year average. Many of them have gotten a little bit more expensive than where they were a year ago after the stock market had declined in 2022, but still not back to average. Yet when you get over to small cap, you would say, okay, now we're a little bit above average. So maybe not expensive, but not cheap anymore. U.S. value, same thing. But here we go. High yield, growth stocks, so NASDAQ and large cap U.S. trading significantly above their long-term average for price to earnings. Therefore, this gives us a measure to say, well, what's cheap? What's fairly priced? What's expensive? Stock market, again, appears to be expensive. Therefore, what do you do with all this? Number one, the question we sought out to answer is, reaching an all-time high, which we've been at, and after the drop in 2002, the recovery for most of 2003, we're back to all-time highs thereabouts. Does that mean another drop is coming? History does not suggest that. History tells us stock market makes all-time highs, retreats off of those, and then goes on to eventually make all-time highs again. However, does that mean everything's in the clear and stock markets aren't in a bubble or aren't expensive? No, I think history would also tell us U.S. stocks are fairly expensive today, and brace yourself for a little volatility and stay diversified. I've shared with you right at the beginning, large cap stocks have recovered, small cap stocks haven't fully, mid cap stocks haven't fully, international emerging, they haven't fully, and therefore staying diversified helps you manage this risk. Stay participating in the markets just in case the earnings grow into this or the economy grows into this, and we don't see a decline, but stocks just continue to rise from here. Being diversified will help with that. Also, if we do see the U.S. stock market take a breather, but some areas, because they're already undervalued or cheap, could help make your portfolio more resilient. So work with your CFP on that, your investment strategy, your risk level, all of that as it connects to your financial plan. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K. WiseMoneyShow.com. You can find us there as well. Or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.